Jake buys property. Jake puts $50,000 into a rental property. Logan puts the same money into index funds. They both think they made the smarter move. Logan invests in stocks. They are both wrong. Because one of them forgot to count the hours, and the other forgot to count the zeros. Both think they're right. When you run the full numbers over 20 years, the gap will make your stomach drop. 20-year gap tease. Let's keep this completely fair. Jake and Logan both have $50,000 saved. Same income, same city, same starting point. Same starting point. The only difference is what they do with that 50 grand. Down payment transaction. Jake uses it as a 20% down payment on a $250,000 rental property. It's a modest 3-bedroom in a decent neighborhood. The $250,000 property, he takes out a 30-year mortgage at 7%. His monthly payment is $1,330. Monthly mortgage, he finds a tenant paying $1,800 a month. On paper, that is $470 a month in profit before he has spent a single dollar on anything else. Tenant pays $1,800 rent. Jake feels like a genius. $470 paper profit. Logan takes the same $50,000 and drops it into a total stock market index fund. No leverage, no tenants, no keys to hand over. Logan buys index fund. He sets up a $300 automatic monthly contribution and does not think about it again. $300 auto contribution set. His coworkers ask what he's investing in. He says index funds. They nod politely and change the subject. Nobody is impressed. Nobody impressed by index funds. On day one, Jake has a house, a tenant, and a story to tell at dinner parties. Jake tells his story at dinner. Logan has a brokerage account and a confirmation email. It is not even close in terms of how it feels. Marcus gets a confirmation email, but feelings and math are two very different things. Jake drives past his property. For the first few years, Jake is living the landlord dream. Rent checks hit every month. He drives past the property and thinks, I own that. Tax deductions. Landlord perks. He is writing off mortgage interest and depreciation on his taxes. He is building equity. Everything feels real, tangible, and smart. Building equity progress bar. Logan logs in once a quarter. Sees the number go up a little, down a little, up a little more. Marcus logs in quarterly. Year 1, 50,000 grows to maybe 55,000. Year 2, maybe 61,000. It does not feel like anything is happening. Year 1 and 2 slow growth. The social proof alone makes Jake feel like he is winning by a mile. Now let's look at the actual numbers through year 3. Year 3 gross cash flow napkin. Jake collected about $64,800 in rent. His mortgage payments totaled $47,880. That leaves $16,920 in gross cash flow. Sounds great until you subtract everything else. Hidden costs rain down. Property taxes, $3,000 a year. Insurance, $1,500. He replaced a water heater for $1,200. Fixed a leaking roof for $2,800. 10 p.m. tenant phone call. Had 1 month of vacancy that cost him $1,800 in lost rent, plus $600 to clean and relist. And he is managing it himself. Calls at 10 p.m. Weekend showings. Coordinating repairs on his lunch break. Real net cash flow revealed. After all real costs, Jake's actual net cash flow over 3 years is somewhere between $2,000 and $4,000. Not the $16,920 that looks so good on paper. Marcus at $76,000, zero effort. Logan, meanwhile, has put in $50,000 plus $10,800 in monthly contributions. At a 10% average annual return, his portfolio is sitting at about $76,000. 0 hours managing it. 0 phone calls. 0 emergencies. Leverage explained visually. But here is where Jake still has a powerful edge. Leverage. His $250,000 property has appreciated 3 to 4% a year, and is now worth around $270,000 to $280,000. Property appreciates to $275,000. His equity, the gap between what the house is worth and what he owes, has grown to roughly $55,000 to $65,000. Equity grows to $60,000. Real wealth, built partly using the bank's money. That is the one advantage stock investors cannot replicate. Vacancy, empty house, full mortgage. The rent check is the number everyone talks about. It is the number on the YouTube thumbnail. The number your landlord buddy brags about at the barbecue. What nobody talks about is everything that comes out of that number before you actually keep any of it. HVAC emergency. Vacancy. The average rental sits empty about 1 month per year. That is a full mortgage payment with zero income to cover it. Maintenance and repairs. Budget 1 to 2% of the property value per year. On a $250,000 house, that is $2,500 to $5,000 annually. Capital expenditure countdowns. Some years it is a $200 faucet fix, Other years it is a $7,000 HVAC replacement you cannot postpone. Roofs last 20 to 25 years. Furnaces, 15 to 20. Water heaters, 10 to 12. These are guaranteed future costs that come in chunks of $5,000 to $15,000. Bad tenant risk. If you are not setting money aside for these, you are not running a business, you are running on luck. And then there is the risk nobody likes to discuss: bad tenants. A tenant who stops paying and drags out eviction can cost you 3 to 6 months of lost rent, plus legal fees. That single event can erase an entire year of profit. Year 7, Marcus at $142,000. None of this shows up in the $470 monthly cash flow number, but it shows up eventually. By year 7, Logan's portfolio has grown to somewhere between $135,000 and $150,000 including his monthly contributions. Compounding curve begins. He did not pick stocks. He did not time the market. He did not do anything except not touch it. The compound growth is starting to accelerate. The gains on his gains are now generating more new wealth each year than his original contributions. This is compounding. Boring for the first 5 years. Astonishing for the next 15. Year 10. Jake equity $177,000. By year 10, Jake's property is worth roughly $335,000 to $350,000. His remaining mortgage balance is $166,000. His equity is approximately $170,000 to $184,000. Year 10. Marcus at $172,000. Logan's portfolio is approximately $165,000 to $180,000. He put in $86,000 total. The rest is pure compound growth, and he spent exactly 0 weekends fixing anything. Year 10. Neck and neck. At year 10 they are surprisingly close in total wealth. Jake might even be slightly ahead thanks to leverage. Jake's hidden cost? Time and stress? But Jake also spent hundreds of hours managing that property. Took on hundreds of thousands in debt. Concentrated his entire investment in one asset in one zip code. Logan diversified across thousands of companies and never lost a night of sleep. Year 20. Jake's property, $475,000 paid off. By year 20, Jake's property is worth roughly $450,000 to $500,000. His mortgage is paid off or nearly there. His equity is $400,000 to $500,000 depending on appreciation. Year 20, Marcus at $440,000. Logan's portfolio at 10% average annual return with 300 monthly contributions has grown to approximately $420,000 to $460,000. Total contributions over 20 years, $122,000. The other $300,000 plus is pure compounding. No debt, no tenants. No 2 a.m. calls about a broken pipe. Jake worked, Marcus waited. When you compare net worth, they are in the same ballpark, $400,000 to $500,000 each. But how they got there is completely different. Jake worked for his. Logan waited for his. Jake had stress, risk concentration, and illiquidity. Logan had volatility, but liquidity and freedom. $500 month contribution boost. If Logan increased his monthly contribution by just $200, bringing it to $500 a month, his 20-year portfolio jumps to roughly $550,000 to $600,000. Because in the stock market, increasing your contribution has a multiplied effect through compounding. In real estate, increasing your investment usually means buying another property, taking on another mortgage, and doubling your workload. 2008 stock market crash. Now if I only showed you the downsides of real estate, I would be doing exactly what every stock market influencer does. Stocks have real risks too. Volatility is brutal. In 2008 the market dropped 37%. In March 2020 it dropped 34% in a single month. Panic selling mistake. Most retail investors panic sell during crashes and buy back after the recovery, locking in losses at the worst possible time. Dividends, only $200 a month. There is no monthly cash flow. Index funds do not send you a check. On $150,000, dividends give you about $200 a month. That is not replacing anyone's income. Real estate advantages. 3 icons. Real estate wins in specific situations. If monthly rent is at least 0.8 to 1% of the purchase price, the cash flow math works from day one. House hacking, living in one unit and renting the others, can reduce your housing costs to near zero while building equity. 1031 exchange explained. And 1031 exchanges let you defer capital gains taxes by rolling profits into a new property. Growing your portfolio in ways stock investors cannot replicate without retirement accounts. Real estate is not a bad investment. It is a misunderstood one. Closing. Did you include everything? The real trap is not real estate, and it is not stocks. The real trap is picking either one based on a YouTube headline, a podcast clip, or something your uncle said at Thanksgiving, without ever running the full numbers for your own situation. The next time someone tells you real estate always wins or the stock market always wins, ask them one question. Did you include everything? Because the answer that includes everything is the only answer that matters.